So where we left off on Monday is we finished 3 of the 4 economic statements that we needed to convert. All right, we did and you can see this here, we did the income statement to TII, we did the balance sheet to TFI, we did the CFI based on those 2 statements, and the 4th statement, which isn't listed here, but it's basically the statement of economic profit. Okay, so that's going to be the 4th tab in our spreadsheet that you're going to have to do as part of your homework assignment, and also midterm exams, etc. So let's talk about the statement of economic profit, which will also be our calculation of ROIC. So here's the thing. We're going to go back to Excel, and we're going to pick up where we left off in the last file. So we're going to add a new worksheet tab, and we're going to call this economic profit, or EP for short. And I'll make it a little bit bigger so it's easier to see. And same relative references as on the other tabs for the years. 3 years, prior, current, and label. All right, so here's the important thing. Economic profit, or EP as defined in the book, is the same thing as economic value added, or EVA. All right, except that EVA is a registered trademark of Stern Stewart, and they're very protective of that trademark. So you pretty much can't use it without paying them a lot of money. All right, so basically, academics, and more importantly, companies like McKinsey, use a generic term called economic profit rather than the trademark term EVA by Stern Stewart. But it's basically the same thing. As you talked about in the book, it's a 1-period change in value for a company, right? And you're going to have to do 2 methods balanced in order to get credit for doing this. So here's how the 2 methods work. We're going to start out with what's called the spread method, which means we have to calculate an ROIC. So to calculate an ROIC, we're going to need to know no plat, which we'll get off of our TII, and we're going to need to know operating invested capital, which we're going to get off of our TFI, and that's going to get us something called operating ROIC. Okay, so copying and pasting this over, that would have been the data from the converted statements that we'd already done. Now, here's the thing. What you're going to do on the homework assignment and on the midterm exam is it's actually going to be called BOY ROIC. BOY stands for beginning of year, right? As opposed to EOY, which would be end of year. Okay, so here's what we mean. To do a beginning of year ROIC, we take the no plat and we divide by essentially last year's invested capital. Okay, so basically the end of last year is the start of this year, and that's called the beginning of year ROIC, which would be approximately 55%. Okay. Now, if we had done end of year ROIC, we would have taken no plat and divided by the current year's invested capital, which would have been around 48%. The third ROIC that is often done is called the average ROIC, which is the no plat divided by previous plus current, take all of that and divide by 2. Average of the 2. 51%. Right? So those are 3 different methods for calculating ROIC. Do I use last year's invested capital? Do I use the current year's, or do an average of the 2? Right? I'm going to arbitrarily choose, just so we all do it consistently for the homework and for the midterm exam, beginning of year ROIC. I'm also going to do that because we do the valuations. It will foot better than end of year ROIC, which will be close. Right? Makes sense later in the chapters. So you don't have to do these other 2 methods right now, but a correct answer for your homework assignment would be the BOY ROIC, which is 55.3, which is, again, current year no plat divided by last year's invested capital. Okay? So in case you're wondering why we do this, it goes back to the valuation. So think of it this way. If I have a company that takes a long time to build a very expensive plant, I don't want to penalize them because that's not representative of how they're doing, because it could take a long time before the plant's built. So I want to look at the ROIC on the plant that's actually built, because that's actually how much they'll make running their business. BOY ROIC. I'm looking at a service business which invests capital expenditures, but it doesn't take long for it to go online. So therefore, it's going to go online pretty quickly. So I'll use end of year ROIC, because EOY is more representative of what that business's ROIC would look like on a go-forward basis. Or I have a business that's kind of cyclical, and some years it does well and some years it doesn't do well. It's bouncing around a lot. So I want to smooth it out to get a better representation of how they do over time. I'll use average ROIC, right? So the point is, in the real world, all of these can be used, and it really just depends on the company you're doing and a better understanding of its valuation. So this is also important just for your own personal benefit. Don't feel afraid, even in your early careers, to ask. Like if somebody says ROIC, to ask, how'd you calculate that? And you're not being, as in, did you use no plan invested capital, but did you use beginning of year capital? Did you use end of year capital? Did you use average capital? Because sometimes people use average, they won't tell you. And if you're trying to recreate it, you might not be sure how to do it. So again, because there are different methods that can be used, be clear about it. For purposes of the assignment, it will actually say BOY ROIC. On the midterm, it's going to say BOY ROIC. So you're going to do it, and I'm going to be clear about it, not going to try to trick you, just so we're all doing it in a constant way as we get started. Make sense? Okay, so I'm going to wipe these out, things that I just added, because I don't want to confuse you further. So all we're going to have is the BOY ROIC. All right, so now we're going to complete the spread method. So the next thing I need is I need a WACC. Now, in this simple example, you didn't have a WACC, so what I'm going to do is I'm going to come down here to the bottom of the data tab, and in the last section, I added a 10% WACC. Okay, I'm just making it up, 10% cost of capital. So I'm going to carry that forward to this tab, so equals 10%, just arbitrary. I'll tell you what the WACC is. So that we calculate a spread, which is the difference between the ROIC and the WACC. Okay, so we have a positive 45.3% spread during this year. Now, if I take my beginning of year invested capital, 380, and I make a 45.3% spread on that capital, then my economic profit is 45.3% of 380. I created 172 million of value this period, called economic profit, also known as EVA. So that's the point. Because I have a positive spread, I've created value. Economic profit just puts that value into a dollar amount. That's the whole point of what EVA was set up to do. Questions about what we just did? All right. Here's the second balancing method. Method number 2. I take my no plat. I then subtract something called the capital charge. My no plat is 210. My capital charge says I had 380 million worth of capital, and I needed to make 10% on that on a risk basis to break even, or $38 million. So I made 210. I needed to make 38. My economic profit is the 210 minus 38. I made 172 million more than was necessary to get an NPV 0 project. That's the whole point of economic profit. So what Stern Stewart did back when they wrote Quest for Value back in the 1980s, an 800-page book that they could have summarized in a paragraph, but nonetheless, what they really said was, managers have a hard time in the real world with percentage targets. If I tell you to go make 10%, it's kind of squishy. If I go tell you to make a minimum of $38 million, it's very tangible. Or let's say a different way. If you have $380 million tied up and you got to make 10% a year, well, guess what? Your target for profit is 38 million or higher. So the whole point of EVA is, number one, it tells you your one period change in value, but number two, what Stern Stewart says is just easier, because in the real world, it's more tangible than a percentage. So it's just easier to communicate targets. And it's been very popular for the last 30 years, essentially for that reason. But nonetheless, that's what economic profit is about. It's about the one period change in value of a firm based on what you spent. These are the two ways to calculate. There's the spread method, ROIC minus WACC times invested capital, and there's the dollar method, which is no plat minus capital charge. And capital charge is invested capital times the cost of capital. So again, back to footing, you'll have to do both methods. They must balance. Just rearranged math anyways. But nonetheless, this is the fourth tab, and this is the fourth economic statement. Questions? Pretty easy. All right. Again, I want to give you one other quick practical real-world example. So a couple months ago, I was in Mexico City with Anheuser-Busch InBev. Tragedy with the earthquake, but regardless, when I was there, I think there's also tragedy they're having with their stock price. Right? We had a little disagreement about this, but this was the perspective that I would take. Right? This is kind of like a rule of thumb an analyst would do, which is Anheuser-Busch InBev bought a company called SAB Miller. Okay? And they spent about $100 billion to buy SAB Miller. Okay? So right now, if I go to Anheuser-Busch InBev, ABI, and if I look at their WACC is about 9%, 8.7 right now. So here's the thing. If I do an M&A, should I be expecting 9%? Well, the problem is if I price the acquisition based on a DCF of, let's assume 8.7 is the right WACC, they have the same risk, just keep it simple. If I do 8.7% as my discount factor, there's no upside in the acquisition, because I'm basically giving the seller all of the upside. If I'm just going to earn the cost of capital, they get everything above. So that's one of the challenges with acquisitions, is I probably should use a different hurdle rate, because if I do 8.7%, I'm going to be NPV zero on this acquisition. So should my hurdle rate be closer to 10 or 6 if I had to adjust this? If I were doing a DCF and I wanted to do a more appropriate hurdle rate, should I use 10% or 6%? All right, for those of you who said 6, go back and take the last class, right, that you were in. You want to make the hurdle higher than the cost of capital. So let's just say 10, just to keep it simple. Might be 12, might be 11. But the point is, I need to make a rate of return to the project. So the point is, whatever hurdle I use is really what I'm going to earn based on the DCF that I do. So if I want to earn more than my cost of capital, people in M&A tend to bump it up a little bit. It drives your value. So here's the point. So let's say 10, just to keep the math simple. Well, if I spend $100 billion, and I'm rounding off, to buy SAB Miller, what's 10% of $100 billion? $10 billion. That means every year they need after-tax operating profit increases of $10 billion incrementally to justify the $100 billion expenditure. If they don't do that, then the acquisition is financially not going to be successful. So here's the thing. If you go to the earnings estimates right now for ABI InBev, last year before they did the acquisition, their pre-tax profit, their EBIT, was $13.3 billion, right? If I need to make $10 billion of after-tax profit, that's probably close to, at any reasonable tax rate, $15 billion of pre-tax profit. Well, this year, their pre-tax profit went up by $4 billion. Relative to this, it goes up by $6 billion. Relative to this, it goes up by $7 billion. Relative to this, it goes up by $9 billion. In the next 4 years, they should have earned, without present valuing this, $40 billion of after-tax profits, which is closer to $60 billion of pre-tax profits, and they're not anywhere near that in what they're actually going to do. So from my perspective, this is not going to be a financially successful acquisition. So this is how I can actually use something like an EVA, or an economic profit in the real world, as a rule of thumb. Because if I know what capital the company has tied up, and I have a sense of their cost of capital, then I have a general sense of what their profit target should be. Now, Anheuser-Busch actually disagrees with what the analysts are saying, and they think that they will do better than this. Right? But what I'm telling you is unless they sell a bunch of assets to reduce the denominator, or they do more with these assets to increase the numerator, they're going to have some challenges paying this off. So here's the point. Look at their stock price. This has been the challenge with their stock price since they announced the acquisition deal. It's been down. And I think the reason it's been down is primarily for what I just told you. Any back of the envelope math you do says that they're just not increasing their profits fast enough to justify the premium that they've historically paid. And I think that's the challenge that the analysts and the community right now has with Anheuser-Busch InBev. It's not that they didn't make a good decision for the business side. You can see that they're growing and making more money. The problem is how much they spent to do it. So EVA is just a shortcut, okay? And that's one way that it might be used. Make sense? Questions, guys? So back to your assignment. This is what you're going to have to do for your assignment. You're going to have to create these tabs. All right, so let's talk about your assignment. If you go to Elms, right, it's called Homework 4. Basically, you can download it right now, and you're going to have to convert this file. Once you convert this file, you'll create 4 tabs. Tab number 1, TII. Tab number 2, TFI. Tab number 3, CFI. Tab number 4, EP. It's an individual assignment, no sharing files. You'll basically upload the file. It will be graded. Okay? Everything must balance and foot and have the correct answers. That is homework 4. Monday, 10 a.m. for all sections. Now, here's the thing. I did one other thing that I thought would be helpful. Helpful for your learning, but it's extra work on your part. I took away all the labels. So you have to label. I'm not going to give you the labels. I think it will be helpful for you and instructive for you to do your own labeling as we go through the process. So there are no labels. So the first thing you need to do is you need to call these things the 1, 2, 3s, or 4s. Operating cash flows 1, non-operating cash flows 2, interest-bearing debt cash flows 3, equity cash flows 4. If you don't label these correctly, you will not do well on the assignment because you won't be able to put things in the right place, and there's a bunch of new categories. So here's what I'm going to do to help you. I'm going to help you verbally right now talk about the labels, but I'm not going to put them in there. Okay? So if you want to write something down, feel free, and it gets you a head start in the process. But otherwise, you'll have to figure this out yourself. So why don't we do it together and quickly talk about what these labels should be. So let's start out with the income statement. Revenue, operating cost, depreciation, all operating. And I told you we could take a shortcut, and the shortcut is operating profit, or EBIT, as our ones. So you can start with EBIT as your 1, and everything above it is a 1 when you do your TII. Save you a little bit of time. That was the shortcut we talked about in class. All right. Interest expense, 1, 2, 3, or 4. What do you think? All right, 3. It's a debt cash flow. Interest income, 1, 2, 3, or 4. What do you think? Interest income operating? Not operating. Okay. So we eliminated 1. Is it non-operating or is it debt? It's 2. It's non-operating. Think about it this way. Number 1, where does interest income come from on the balance sheet? How do you generate interest income? Yeah, you invest your excess cash and you buy bonds or something else and make some interest expense. That's non-operating, right? So here's what's interesting. Interest expense is financing. Interest income is non-operating. What people will do in the real world is they'll have something called net interest expense. They'll net the two together. If you think about it, there's something kind of flawed in that, right? Because what they're doing is they're mixing operating and non-operating together. But they do this all the time, right? So I'm just telling you that sometimes people do it for purposes of shortcut. That's probably why they do it. But you will know that somebody took a shortcut and they probably did it for practical reasons, but academically, they're actually mixing cash flows that are not quite completely mapped to Modigliani-Miller. So I don't want you to go to somebody and say, oh, you're doing it wrong. But what I want you to understand is, conceptually, they may be doing it for reasons that A, they don't understand, or B, they're taking a shortcut, and it's just the way they're doing to be practical. But nonetheless, that's why I want you to do labeling, because you'll actually start to understand this when you get to the real world, why people do certain things. And sometimes that you can actually help them improve the way they do it and get a better evaluation. Regardless, interest income, 2. Non-operating income or loss, 2. Taxes on the income, 1, 2, and 3. Minority interest payments on the income statement. These are dividends to shareholders that are minority shareholders. 4. We're going to call those equity payments. And they're already after tax. So you don't tax affect the minority interest because it's already after tax. And one way you can always check on this is notice it's below the tax line. So things below the tax line have already been taxed. You don't want to double tax it. Your statements will never balance. Net income. Who's that belong to? 4s. Net income is the 4s. Okay. Preferred dividends. 4s. Common dividends. 4s.
Is income before tax also 4?
Income before tax is actually like a sum of the accounts above, so we ignore those, kind of like the intermediate account. With the one exception of EBIT, we're kind of cheating on EBIT. All right, let's talk about the balance sheet. Okay, scroll down. Operating cash. Notice I've separated it out. What's operating cash? 1. Excess cash. 2. That's the non-operating cash flow. This is what I talked about splitting them out in the last class. All right. Accounts receivable. 1. Inventory. New account. Other current assets. So here's the problem. We don't know because it's this miscellaneous category. So in the real world, we start having to go to the footnotes. We're going to go figure out what this stuff is and then make a determination. All right. Without knowing, without looking at the footnotes, I'm going to bias it to being a 1. All right, and here's why. If we exclude it, we're going to have less invested capital, higher ROIC. And if it's an ongoing part of their business, I'm going to overvalue them. So what I'm going to do is I'm going to penalize you for spending something and say it's a normal course of business unless proven otherwise. So I'm going to treat it without knowing it as operating. All right, but the reality is might be a non-operating. So I really need to figure out what is it. And the easiest way, if you don't talk to the company, is this is where the footnotes on the 10K and the 10Q can be very helpful because it'll tell you what it is. All right, but nonetheless, we're going to call it a 1 for purposes of this assignment. Net property, plant, equipment. 1. Goodwill and intangibles. If I build a plant, net PP&E, it's a 1. If you build a plant and then I buy your company to own your plant, well, the idea is that I'm running the plant. If I buy your company, I'm buying it with the idea that I'm going to run your company. Therefore, goodwill should be operating, and it should be a 1. Goodwill is always operating. If I didn't want to operate it, it should be an equity investment. All right, if I want to be a passive manager, that's an equity investment. If I'm an active manager, by definition, that's operating. That's the whole point. I buy you because I want to run your business. It's just a more expensive way of building something than building it greenfield, but it's the same idea. I'm building it with the idea of operating it, so goodwill is operating. Equity investments. Well, we talked about this in the last class. There are actually 2. Those are the non-operating passive investments that I referenced 45 seconds ago. All right, short-term debt. 3. This is why you can't call all current liabilities part of operating working capital. Accounts payable. 1. Other current liabilities. We're going to apply the same rule to the other current assets. It's 1. It's operating unless we're proven otherwise. Long-term debt. 3. Other long-term operating liabilities. Other long-term operating liabilities. 1. Other long-term non-operating liabilities. 2. This is a new account, so make sure that just like when we set up the first TFI as an example, we netted the operating assets against the operating liabilities. We net the non-operating assets against the non-operating liabilities. Okay? So make sure you net that. Okay? Minority interest on the balance sheet. This is the equity stake of the minority shareholder that we've subsumed. It's a 4. Preferred stock. 4, that's equity. Preferred and common are both equity. Common stock at par value. 4. Retained earnings. 4, that's equity. Treasury stock. What is treasury stock? What causes treasury stock? Go ahead.
Buy back shares.
Yeah. You bought back the common shares you previously issued. That's your treasury stock. So what would that be then?
4.
It'd be a 4. Be an equity account. So treasury stock is a contra account on the balance sheet. You learned this in accounting. So the idea is I issue the stock at par value, common stock plus additional paid in capital. I repurchase the stock at market value, treasury stock. So I have the amount I issued, dollars. I have the amount I buy back, negative dollars. I net the two. That's my net equity position. Now what's interesting is because I'm usually buying treasury stock at market prices, I could actually quickly go in the hole because I could buy it back at a lot more than what is outstanding. And that could actually drive my equity negative. But regardless, a negative treasury stock means it's a contra account to equity and it represents the dollar amount of what has been repurchased. So if a company went from -5 to -250 treasury, what happened? I'm sorry? Did they buy or sell stock? If it goes from -5 to -250 for treasury, what does that mean? Did they buy stock or did they sell stock? They bought back their shares. The difference between the two is how much shares that were bought back. On the CFI, that's a positive number. That's the hint I'm giving you to help you make sure you do the CFI. Okay, so notice the tax rate down there is 30%. WACC is 8. I mentioned use BOY capital to calculate ROIC and EP on that final tab, just as a reminder. All right, and you don't have to worry about CapEx because we're not actually solving for CapEx, but later we'll actually solve for CapEx, but you won't need to do that to complete this homework assignment. All right, so long story short, questions about any of this? This is homework 4. Sorry? Taxes on income 1, 2, and 3. We'll spread it out to each one of the areas. Yes?
So I know the example you did, there were 2 periods, and on this there are 3. Is there a difference in how we're going to
Nope. You're just copy and pasting the rows. So you'll have 3 columns versus 2 columns worth of data. So you'll have 3 years of TII, you have 3 years of TFI, but you only have 2 years of CFI because you need to change the balance sheet, and you'll have 2 years of ROIC EP because you're doing last year's invested capital. So 3, 3, 2, 2 will be the amount of years each of the things. But again, because you're copy and pasting, I could have put 6 years on here and it wouldn't have mattered. Because you just, like I said, once you identify in the right area, copy and paste the rows and it should all foot and carry over. Other questions? All right, last comment I want to make and then we'll end today. This is more for your benefit. If you had bought the book, the 6th edition, and if you were following along what we did in the 6th edition, you would have seen that the book has a different example answer in the 6th edition than in the 5th and previous editions. So when I saw the 6th edition, Dave Wessel's a friend of mine, I called him and I said, Dave, what's up? Because this doesn't make any sense. There's an error in the 6th edition. He said, we know, but we intentionally made the decision at McKinsey to put the error in the 6th edition. So I want to be very careful if you're actually following the book to know why they intentionally put an error. into the 6th edition because they did it for practicality. And I want to show you the error and said the TII and the TFI. And that's why I called it in your PowerPoint the old TII and the old and the new TII. Okay, so here's the old. What we did in our last class, you can kind of see it right here, is, and I'll be specific, if you look at non-operating income, this number here, it was $4 million. And when we converted in the last class, we said you'd pay $1 million of taxes on non-operating income, and your after-tax non-operating income was $3 million. That's the correct way to do it according to academic theory. In the 6th edition, this is the actual table. 4 million, 4 million. And so I was like, why isn't it 3? And oh, by the way, interest expense. Remember we did interest expense? 20 million, 5 million of tax shield after tax interest expense. In the solution here, 20 million of interest expense. What happened to the tax shield? So I asked Wessels. And what he said was, a little inside information, when they were doing the actual 6th edition, there was a debate. And the debate was that the actual CFOs and the actual controllers that are doing this in the real world are struggling to move the tax things around the actual converted statements. Right? It's just really hard to do. And to some degree, it was confusing them. So for practical reasons, they debated, but the managing partner had final sway and basically decided that they would change the statements in the 6th edition to make it easier for a real company, shortcut, to calculate TII the way they did it and CFI by not moving in and creating the concept of a tax shield and bundling it all with the interest expense and interest income all into the non-operating side. And I said, well, that doesn't completely follow the logic that's explained in the book. He said, I absolutely know, but we actually did it to try and make it easier for companies to do. I only say that for 2 reasons. Number one, if you're actually reading the book and trying to follow the slides, you're like, what the hell? This looks different. Yes, it does. And number 2, this is a perfect example of how McKinsey is trying to be practical. So on the one hand, they understand the theory. They know they made a mistake, but they made the mistake to try and be easier for their clients to implement. All right? So I'm not going to criticize them and say they made a mistake. Like, they're actually trying to help people do something that's better than what they would have done by at least converting the statements, but they try to make it easier than the academic method that they had to do. Now, here's how it applies to you. I want you to do it right. Okay? So I want you to do it the way we talked about on Monday, which means put it into the actual accounts. You guys are pretty smart. You will figure out how to do it. And to be honest with you, it's more straightforward. Because if I tried to explain it to you this way, you'd be even more confused than you are now. Because I'm like, oh, this stuff you reallocate, but that stuff you don't, and that's just arbitrary. Like, I just don't like the arbitrariness of the rules. But this is just an illustration. In the real world, people will set up shortcuts to make things easier. And it doesn't mean they're wrong. There's a rationale for doing it. And you'll run across this. And what I want you to understand, you'll get out of this class, is that there was a shortcut taken here. You may not know why, but that's what you'll start to have a better understanding. That's why I want you to do things like the labeling process. That's why I want you to do these conversions. You'll have a much better understanding of what's going on. All right, so we're going to pick up on Monday with this solution assignment going to next week. Finish up the teams. I just recorded this. This will be posted on YouTube. Have a good weekend.
Yeah, did you hear that?